You think you understand wealth because you've seen it. The mansion, the car, the yacht. What you're looking at is the smallest, most visible fraction of how actual wealth works. The things you can see are almost never owned directly by the person who uses them. The mansion belongs to a limited liability company registered in Delaware or Wyoming. The LLC was formed by an attorney and lists no individual name in any public record. The car is a company vehicle. The yacht is chartered through a trust. The person who uses all of it every day owns on paper almost nothing. This is not a loophole. This is architecture. The wealthy don't hide money the way you might imagine, stuffed in offshore accounts, buried in secrecy. They restructure reality so that the money was never theirs to begin with, at least not in any form the system can easily reach. What you're taxed on is what you own. What you're sued for is what you own. So the answer to both problems is to stop owning things in the name that appears on your birth certificate. Here's the trade that most people never learn exists. You have $50 million in stock. If you sell it, you trigger a capital gains event. You pay tax, 20%, maybe more, depending on your jurisdiction. You walk away with $40 million in a tax liability. Or you do what wealthy people actually do. You go to the bank. You use the stock as collateral. The bank loans you $20 million at a low interest rate, often between 1 and 3%. You now have $20 million in cash. You have paid zero tax. The stock is still yours, still appreciating, still generating dividends. The loan sits against it quietly. The interest is sometimes deductible. The cash is yours to spend on whatever you want. And from the government's perspective, you have earned nothing, realized nothing, and owe nothing. This strategy has a name. Buy, borrow, die. You spend borrowed money your whole life. You never sell. When you die, your heirs inherit the assets at a stepped-up cost basis, which means the decades of appreciation are erased for tax purposes. They pay off the loans with a fraction of the inherited wealth. The rest passes through essentially untouched. The tax event that should have happened never does. A trust is not a secret. It's a legal structure. But what it does is transfer the practical ownership of assets into a vehicle that operates under its own rules, governed by its own documents, managed by a trustee who may be a professional firm, a law office, or a carefully selected family member. The person who created the trust, the grantor, can still benefit from it, can still live in the house it owns, can still receive income from the investments it holds. But they do not own it. And because they do not own it, it is not counted in their taxable estate when they die. Irrevocable trusts are the serious version. Once formed, you cannot easily undo them. The assets are gone from your balance sheet. Estate taxes cannot touch them because they are no longer yours. If someone sues you, they cannot reach them for the same reason. The wealth has moved into a structure that exists across generations, governed by language written by attorneys who have spent careers designing exactly this kind of transfer. The family that does this in the first generation protects wealth for the third generation. That is what dynastic wealth actually means. Not a large number in a bank account, a structure that makes the number untouchable. Money does not have to live where you live. This is obvious when you say it aloud. It becomes remarkable when you examine how strategically it is applied. Certain jurisdictions, the Cayman Islands, Luxembourg, the British Virgin Islands, Switzerland, have tax and disclosure structures that make them useful places for wealth to be technically located, even when the person who controls that wealth is physically somewhere else. Shell companies in these jurisdictions hold assets, receive income, and operate behind layers of nominee directors and registered agents. The paper trail becomes deliberately long. Not illegal, that distinction matters and is worth stating clearly, but long enough and complex enough that understanding who ultimately benefits requires access to documentation that is often private, sealed by jurisdiction, or simply not required to exist. The wealthy don't do this because they are criminals. Most of the time, this is entirely legal. They do this because the geography of money is itself a financial instrument, where something is determines how it is taxed, how it is disclosed, and who can make a claim on it. Location is leverage. None of this happens alone. The single most consistent feature of serious wealth is not a specific strategy. It is a team, a tax attorney, an estate planner, a private banker, a family office that coordinates across all of them. These advisors do not advertise. They are accessed through relationships, through referrals, through the kind of social infrastructure that exists only inside certain rooms. The strategies they deploy are legal. They exist because the people who write tax law and the people who benefit from these structures are often connected, not conspiratorially, but professionally. The code reflects decades of lobbying, precedent, and legislative choices about what to tax and what to leave alone. What you are looking at when you look at hidden wealth is not mostly crime. It is sophistication applied with patience. It is structures built over years by professionals who have done this before, for a class of people who understand that the rules apply differently depending on how well you understand them. The asset is never the money. The asset is knowing how money actually works. Everything else follows from that.